We've all been having concerns about going through a recession in 2023. We're also living through a war in Eastern Europe and increasing oil prices, which is enough to worry investors. This is why you might have heard more about options trading and how it has increased during the past year. As a matter of fact, the traded options contracts have increased by 4.5% between 2021 and 2022. You might have heard how lucrative it is, and good strategies used in options trading might limit your loss risk, but you still don't fully understand what it is. Worry not, for in this video, we will explain some main points to help you grasp the central concept. So let's get right into it. Portfolios of the best investors are usually diversified and include several kinds of assets. Those assets can be ETFs, stocks, mutual funds, or bonds. Options are yet another asset class that can add value and huge advantages to a portfolio. Options are made into contracts, which are predetermined agreements that give certain rights to the holder but do not oblige him of its clauses. The options contracts allow the holder to trade a certain number of securities at a set price within a certain time limit. An investor doesn't have to be the owner of those securities in order to buy or sell an option. There are usually two parties involved in options trading. The first is the holder or the buyer of the options, and the second is the writer or the seller. The holder is usually an investor who intends to buy contracts, while the writer is the one who creates those contracts. What happens during options trading is that the holder would pay a premium to the writer to have the right to trade a certain stock within a certain time. The premium is the fee per share, and it is what the holder would usually lose if he lets the contract expires. What makes options trading so lucrative is that the holder is able to bet on the performance of a stock without having to risk his money in investing that stock. They'd only lose the amount put as the premium for the writer. Now that the basic is clear, let's go over some details. Options trading is like betting on a stock whether its price would increase or decrease, when and by how much. The contract is then created to either buy or sell that stock as per the parameters set. When the holder is given the right to buy a stock through the contract, this would be a call option. But when the holder can sell a stock through a contract, it would be called a put option. Although this sounds simple enough, options trading isn't for beginners. This doesn't mean that you shouldn't understand what it is, but you must know that investors trading options must be confident and knowledgeable enough about the stock market. So let us know in the comments down below if you feel you understand it better and if you are interested enough to learn more. Don't forget to like this video and subscribe to the channel for more informative videos. See you in the next one.